Welcome back to our final session of day 2 of the Nature for Life Hub. Remember, if you are joining us on social media, please use the hashtag #NatureForLife to be part of the conversation. We want to hear from you. This final session of the day forces us to think big and be creative. Please enjoy our closing session, Innovations in Private Finance for Nature's Missing Middle.
Welcome, and thank you for joining us for the final session of the Business and Finance Day, part of the 4-day Nature for Life virtual event in the margins of the United Nations 75th General Assembly. My name is Nigel Purvis. I am the CEO of Climate Advisors Group, a family of organizations working to deliver the low-carbon economy through research, analysis, public policy advocacy, and communication strategies. It is a privilege to be opening this session on behalf of the organizers today, the United Nations Environment Program, One Planet Business for Biodiversity, the Global Ethical Finance Initiative, the United Nations Development Program, and the Finance for Nature Virtual Global Series. Natural climate solutions are facing a major challenge. There's a huge gap between the growing amount of financial capital that wants to invest in these solutions on one hand, and the businesses and projects on the ground that can actually deliver the desired positive impacts at the scale and scope necessary to meet biodiversity, climate, and sustainable development goals. This is what we mean by the missing middle, that there's plenty of demand for natural climate solutions and an abundance of potential supply, and yet the financing for action remains a challenge. Today we'll hear from a range of speakers who will discuss new markets, new instruments, and new capital for green, circular, and inclusive growth. Business as usual, of course, is not an option. The World Economic Forum reported earlier this year that half of the world's GDP is potentially at risk from global environmental threats. Nature-based solutions can not only help manage these risks, but can create positive, inclusive economic growth, estimated at up to $10 trillion in revenue and nearly 400 million jobs by 2030. So let's start hearing about how to fill the missing middle. It is my pleasure to introduce the moderator for this session, Helen Edmondson, who will guide us through the program. Helen is the head of International Strategy and Engagement at the UK Department of Environment, Food and Rural Affairs, as the UK will be hosting the Global Climate Summit next year in Glasgow, and as the UK has identified sustainable finance and nature as two of the key pillars for that summit. Helen's leadership today is both timely and greatly appreciated. Helen, over to you.
Thank you so much, Nigel, for those kind words, and what a fantastic way to start our session. Good morning, good afternoon, good evening to everyone who is live streaming in today to this, the 4th and final session of the Business and Finance Day under the Nature for Life series, where we're going to be looking at innovations in private finance for nature's missing middle. We will be looking at the opportunities and challenges facing SMEs, but not just any SMEs, those businesses that are investing in nature and nature-based solutions, delivering benefits that address 3 critical needs. First, the need for access to economic livelihoods and jobs. Second, the need to find solutions that reverse catastrophic loss in biodiversity. We've heard a lot over the last few days and indeed the last few months and years, and some of these alarming statistics about species loss, deforestation, and ecosystem degradation. And third, solutions that can combat climate change, both by increasing resilience to that climate change and by helping mitigate against it. And nature is amazing. It does all of that and so much more. And yet, despite this potential, only around 3% of global climate finance goes to nature-based solutions, a figure I'm sure that everyone is very familiar with and has been spoken about, not just in this series, but in others as well. Land-based sectors, and indeed marine-based sectors, offer huge mitigation potential. The agriculture, forest, and land use sectors account for about 23% of global greenhouse gas emissions, second largest to energy. And much like we've seen in the energy sector, a transformation is needed. We've seen R&D, feed-in tariffs, regulatory reform, and now we're seeing falling costs in renewable energy. We need a similar investment and concerted effort across the land and marine-based sectors so that we can support this full-scale transition towards sustainable pathways. And that is why nature is a core theme of the UK's presidency of the UNFCCC's COP26 that we are indeed hosting in Glasgow. And we are looking to increase ambition across 4 campaigns under that nature theme. First, sustainable land use and commodities trade. Global trade of forests and agricultural commodities drives over 80% of deforestation in the tropics. And we're hoping that by working in partnership with governments, businesses, and civil society, we can move towards more sustainable practices. Second, we have a campaign around sustainable agriculture, building on the just rural transition that the UK launched in partnerships with others at the UN Climate Action Summit last year. Third, raising bold political ambition. The UK has been working with a number of other countries to create a bold leaders' pledge for nature. And then finally, finance, more of it, from public sources, private sources, but also working with the international financial institutions to really put nature into economic and financial decision making. I think we all heard from Professor Das Gupta around the importance of that. Nature is part of our economic model, it's not outside of it. And we need more finance that recognises that. We need better finance that recognises the risks of not doing so. And so if we're going to fulfill these ambitions on more finance and better finance for nature, we need innovation, which is why we are here this afternoon, where we're going to talk about innovation specifically in finance for SMEs. And SMEs are particularly important. 60% of jobs and around 40% of GDP in emerging economies. These really are the backbone of these economies, people's livelihoods. And for SMEs that fall under this banner of missing useful for them in just isolated form, but they're too small for the traditional financial lenders, whereby they're still seen as far too risky. And so where do they go? They're looking for ticket sizes of around 1 to 10 million. They need debt, they need equity, and it's not there, or it's difficult to access. It needs to be packaged in different ways. So I'm hoping this afternoon that we're going to take you on a journey over the next 1.5 hours or so, looking really at what those challenges are, but also hopefully we can talk a little bit about the solutions to those and the opportunities, especially as we move into 2021 with COP26 and COP15. And we have a fantastic panel to provide us with those insights. And I personally feel that what is fantastic about this panel is not just that they come from a range of institutions, but actually, if you look at their backgrounds, they bring a fantastic and diverse array of experiences that we're hoping to tap into this afternoon. So we have at the forefront. He's definitely no stranger to risk. We have Katerina Olemoyoy, Sustainable Sourcing Specialist at Kering. She has over 10 years of experience working on sustainability issues and working in partners across the globe. We have Richenza Van Nieuwen, Executive Director of the Aspen Network for Development Entrepreneurs. She has an amazing experience of working on gender-based investment, microfinance, and renewable energies. We have Pierre Rousseau, Senior Strategic Advisor, Sustainable Business at BNP Paribas. He has fantastic experience working in this organization, but also other financial institutions and banks, and also across several regions. And then finally, we have Nano Kleiturp, Chairman and Board of Directors of And Green, and he brings a wealth of experience across investing, impact investing, and importantly, investing in resilience and sustainability. So first, I am going to turn to Toby. Toby, fantastic to have you here this afternoon. Welcome. So you bring a fantastic perspective of a business that can provide nature-based solutions that can make a positive impact. Especially for an SME, while also being able to stay true to your nature.
Hi, Helen. I think you probably turned it over to me. You cut out for a few minutes there, so I wasn't quite sure how you were making that transition, but nevertheless, let me get started and tell you a little bit about Forest First and some of the challenges that we have faced in this whole area of the missing middle. Forest First was a company that was started back in 2010 by 5 founders who had reasonably good careers in the financial sector and wanted the opportunity really to get involved with an impact investment and give back and have a bit of a legacy as a result of long careers in other ways. And those 5 founders spent 2.5 years doing due diligence all along the equatorial belt to look for what we believe to be the best country on earth to do large-scale sustainable forestry. And the reason we were keen to do that is we felt it gave the opportunity to be as impactful as we could be, not only locally in the country that we were involved in, but potentially globally. And in this context, where there's been a growing awareness of the impact that forestry, especially in degraded lands, could have on mitigating the negative effects of climate change, as well as the fact that doing this in the equatorial regions, which is necessary if you're going to be a low-cost producer of wood fiber, you also have the opportunity to have a transformational impact in an emerging market country, because for the most part, all countries along the equator would be in that category. We spent over a year in Africa and over a year in Asia, as well as a considerable amount of time in Latin America, before we finally came to Colombia. And for those of you who are familiar with Colombia and its past, it often evokes quite visceral feelings about narcos and political strife that's been going on for years there. And we almost passed it by as a result, but I'm very glad that we didn't. Because when we came to Colombia, which sits just across the equator from Brazil, in one of the best growing regions of the world, what we uncovered was just a terrific opportunity to establish large-scale plantation forestry, and for us to be a low-cost producer. And in becoming a low-cost producer, it gives you the opportunity and the flexibility to do a wide range of other things from a social and environmental perspective. We had no idea at the time we started the company in 2010 that we would face the capital raising challenges that we have faced. And I'm just going to walk you through a brief history of the capital raising that has taken place at Forest First, because we have gone through this entire transition, if you will, of the missing middle. We funded the company originally through the 5 original founders for the first several years of the company's existence. And after that, we quickly learned that the development banks, who we thought would be a very good source of capital given the mission of the development banks, we learned very quickly that they were not prepared nor interested in funding a sustainable plantation forestry company, even with very significant benefits socially and environmentally, at the stage in which we were at. In other words, at the greenfield stage, all institutional investors that we had come across were completely uninterested in providing equity capital to the business. And as a consequence, all of our funding for the first 5 years following the initial founding of the company came from high net worth and family offices. And they were done one at a time in very small investments ranging from as low as $500,000 to a few $1 million. And over that 5-year period, we raised about $30 million in that way. And that money was then put into the ground, and both in terms of acquiring land as well as in terms of planting trees, till we got to the point of having about 5,000 hectares planted, and we owned about 20,000 hectares of land. And it was at that point that we felt we could revisit institutional investors because we had now proven that trees could grow very well in this region, that the team of people that we had engaged in it were quite good at doing exactly that. And we reapproached, if you will, the institutional market, including the development banks, but also the pension funds, the endowment funds, the life insurance companies, and really those sorts of institutions that tend to hold forestry assets in their portfolio long term. And what we got were really nothing but offers for debt. And here it's important to know something about greenfield sustainable plantation forestry. It is a long-term investment. Even in the best places on earth with which to grow trees, it takes 12 to 15 years before you see your first dollar of real cash flow. In Colombia, in the eastern plains of Colombia, where we're planting trees, we're on a 7-year rotation, which means that the trees that we put in the ground 7 years later, we would be harvesting them for revenue. And by the time you get sufficient volume, you're a few years into it to begin with. And so it's quite reasonable for that to take you 12 years, which is one of the challenges that you face when you're trying to raise money. And in that context, it's almost impossible to accept debt, although that in many other forestry companies examples that I could give you, that's the only capital that has been available to many of these companies. And down the road, there's an inability to service that debt, or both the principal and the interest on that debt. So in that sense, there are real challenges in raising money for forestry companies. And as a consequence, we had to look outside that box. And ultimately, we ended up doing a transaction at the end of last year where we sold forward all of the potential carbon credits this project would generate over the next 10 years to Shell Oil, who was developing a carbon trading desk and was interested in buying those carbon credits. And we hope now that that transaction is completed at the end of last year that we will have the opportunity going forward to look to the institutional market for further funding for this project, but that remains to be seen.
Thanks, Toby. Just to step in here for a second. Unfortunately, Helen's having some connectivity issues, so I'm just stepping in temporarily, hopefully, and we'll follow up with a question for you. So Toby, thanks so much for that start. Sorry, I should introduce myself. Peter Graham, Managing Director at Climate Advisors. Really amazing work that you've done and the progress that you've achieved. I want to get into a little bit of the issue that you brought in, or your experience. How important is the bundling of assets, such as trees, biomass, carbon storage, in securing sufficient finance for businesses like yours? How can we stack the different financial flows so that we can tilt the balance on profitability?
Yeah, well, that was part of the search for the ideal location in our case with Colombia. So oftentimes when you're looking at plantation forestry, you're going into a region where it's very difficult to achieve scale because you've got either displacement of people issues, or you have to take out a natural habitat or some portion of a natural habitat to establish that sustainable plantation. And in the case of Colombia, what we have here is really an ideal set of circumstances where you've got really tens of millions of hectares of highly degraded land in an area where there are very, very few people. And it gives rise to the opportunity in this instance to turn a very big net negative, where you're planting trees in an environment that is often burned every single year by the few people that live there. And as a consequence, you turn what is really a highly degraded land into a very big carbon sink. So in our case, for example, 150,000 hectares planted will sequester approximately 24 million tons of carbon and rehabilitate the land that we're on. And that should obviously become very appealing to anybody interested in the environmental space. But at the same time, you're also then providing economic opportunity in a region where there were no jobs whatsoever. And in fact, the only jobs that were in place there would be those connected with narcotics. So you have now the opportunity to bring political stability, social mobility, economic opportunity, not only to men, but to women who are heavily employed in areas like our nursery, for example. And it's really packaging all of that together along with the wood fiber, where that wood fiber is being directed into places which are also very impactful from an environmental perspective. So, for example, we would intend to sell approximately 1 million tons of wood a year into the bioenergy space, which is mostly directed in Europe towards reducing the amount of coal that is used in the generation of electricity. But we'd also be selling that wood into places like pulp and paper, where that wood fiber would be used in the areas of developing clothing, for example, which mitigates the need for cotton. and so on and so forth. And so for us, it's been very important to try to stack all those things on top of one another to make us the most appealing, if you will, to all institutions who might be interested in being involved with a company like ours.
Toby, thank you so much, and apologies to everybody that my internet connection isn't fantastic. What can I say? London broadband isn't what it should be. Toby, thank you so much. We're going to move now to Katerina. So Katerina, fantastic that you're on our panel, and unlike some of our other panelists, Karine is obviously not a financial investor. In fact, you're a luxury fashion group, and most of your direct operations and supply chains are actually in Italy and elsewhere in Europe. Can you talk to us a bit about why Karine is interested in investing in nature-based solutions? I must say, I thought it was fantastic with your strategy, your biodiversity strategy coming out this summer. That's fantastic. Could you talk to us a little bit about why you guys have made this shift, and potentially an actual example of what this is looking like on the ground?
Sure. And firstly, just thank you so much for the invitation. It's really a pleasure to be here. I think I'll answer the question in two parts. So firstly, why does Caring invest in nature-based solutions? I think that, like many people on this panel and probably in the audience, we just believe that the world is not moving fast enough when it comes to responding to the environmental crisis at hand. And that includes not just climate change, as we've already talked about, but also the interconnected biodiversity crisis. And so as a large private company, we believe that we have a fundamental obligation not only to champion, but also to invest in nature-based solutions. Now, the second reason is actually that there's a direct connection to our supply chain. And so for listeners who are not familiar with Caring, as you mentioned, we're a luxury fashion group. We have headquarters in Paris and around 35,000 employees around the world. Some of the people in the audience might be more familiar with our brands, which include Gucci, Brioni, Balenciaga, to name a few. And so actually a little bit of a confession, which is that I'm actually quite new to the fashion industry myself. My training is as a sustainability scientist with expertise in agriculture. But it's actually a pretty natural fit because there's a very tight connection between agriculture and fashion, and even forestry and fashion, as we just heard about. And so all of the products that our brands sell start their lives on farms, on rangelands, and in managed forests all over the world. And so the reason that we invest in nature-based solutions is because when we protect the ecosystems that produce those products, we're protecting the health of our business as well. And so for me, that's very exciting because what it means is that you can unlock a lot of conservation opportunities through this win-win setup that we have. So you asked for a concrete example. I think it's helpful to start back in 2012, actually. Caring was one of the first large companies in the world to introduce what's called natural capital accounting. And basically what that means is we look at the environmental impacts of every kilogram of every material in our supply chain, and we measure it from the time that it starts its life on a farm all the way up until the point that it's purchased by a customer. We're now working on end of life as well. But this is, we call this environmental profit and loss account statement, and it's something that is fully open sourced, it's online. And so if anyone wants to really dig into the details of it, they're welcome to. It's on our website. Now, the power of this tool is that it allows us to really drill down and understand the relative impacts of the different materials that we buy. And so one thing that was, I think, quite surprising for the team, and this is before I came on board, was that cashmere, which comes from Mongolia and China, has a really large environmental impact relative to other materials that we use. And so for people who don't know, cashmere comes from goats, and it's actually a really important part of the Mongolian economy. There are tens of thousands of people who make their living in the industry. And as you can imagine, it's one of these scenarios where you had skyrocketing global demand over the last 20 years, and you had people rationally respond by increasing the sizes of their herds. Understandably, this led to a situation where you have grasslands and rangelands in a very deteriorated state. And so which just begs for action, because unless you protect this resource, you end up with really grave economic consequences as well. And so about 5 years ago, we put a program in place on the ground in partnership with Wildlife Conservation Society that is really all about grassland management through practices such as rotational grazing. The reason I find it particularly exciting is because there's, as I've said, there's a direct connection to our supply chain, and our brands are able to source the fiber that comes out of that product, out of that project directly. And so, basically, so looking at the EP&L, we're able to really justify making an investment in a conservation program that has very real benefits on the ground. I guess the last thing I'll say about that is that recently Stanford joined this partnership with funding from NASA. And what they're doing is using remote sensing data to try to build models that we can use to predict where herders might move their goats going forward. And then, so it's a really exciting project, and I think it's a nice illustration of why we invest in nature-based solutions.
Katrina, great. And it's funny, isn't it? I think we have to have a whole reset of our metaphors, talking about concrete examples and a stone killing two birds. But that was a really great example. Interesting how we really do need to look all the way from our supply chains. And I liked some of what you touched on as well about the end of life work as well. Could you talk to us maybe just really quickly about some other raw materials and fibers and what else is in the pipeline for going? And then your points on natural capital accounting, which I really liked. I think we're going to come back to in a bit of the Q&A at the end.
Okay, great. Yeah, so you mentioned that we released a biodiversity strategy that was done back in July. And it's one of the first in our industry anyway, that really directly addresses the biodiversity question and crisis. And so in that strategy, we made two pretty big commitments. The first one is outside of our supply chain. And so I mentioned that there are obviously these critical ecosystems around the world that need protection. And so our first commitment is to protect 1 million hectares of these critical ecosystems outside of our supply chain. And then the second commitment, and this is what I work on directly, is a commitment to protect 1 million hectares within our supply chain landscape. So really looking at where our materials come from. And we've jointly launched a fund in partnership with Conservation International for this work to focus on 4 materials that have the highest environmental impact according to our EP&L. So cashmere is one of them, but the others include leather, wool, and cotton. And so I guess last point that I'll make here is that if you take those that million hectares in our supply chain and the million hectares outside of our supply chain, what that translates to is an area that's 6 times carrying's environmental footprint. So, and this is all by 2025. So it's quite ambitious. We're very excited about it. But we also recognize that it's not going to be easy, and it will require deep partnerships with NGOs, with local communities, scientists, and many others. And so we're really excited to get started on this journey.
Fantastic. Well, we love ambition. So fantastic that you're here. We'll be all watching towards 2025. And we're going to shift now to bring in Pierre. Pierre, BNP Paribas, this is where you're sitting. It's got a long history of leadership and innovation in the fields of climate, biodiversity, natural capital, both as part of their core banking business, but also part of their sort of CSR and philanthropy as well. In fact, you've got 3 amazing funds: the Global Fund for Coral Reefs, the Tropical Landscapes Finance Facility, and the Subnational Climate Fund. Great if you could talk to us about these and maybe any other instruments that you were designing to address the missing middle of SMEs. Over to you, Pierre.
Yeah, thank you, Ellen. And yes, what is important to understand is when we talk about finance, finance is part of an ecosystem, and we are between an environment where we have clients, we have employees, we have regulators, because we are a regulated business. And so it's very important that in this environment, and when we have a world which is changing, that also finance is changing. The majority of the way that green finance has been growing, it's mainly by starting of taking the products that we have, like the bonds, the loans, what we do in terms of trade finance, and to try slowly to green it, to blue it, or to sustainable it by creating some environmental and social rules related to it. But we do realize that at the end, when we talk about natural-based solution, or when we talk about creating impact, because at the end, what we have to do is to reduce gas emission or to address typical biodiversity regenerating. So we need to come up with solution, and solution is not coming alone. And this is why I would like to present to you here a few examples. First of all, not all of them are fund, or we call them sometimes facilities and fund, because sometimes we may use different mechanisms. The idea is to have the toolbox of finance to create approach. And what kind of approach are we creating? First of all, is to create project. Don't believe that finance will solve all the problem. Finance is just a mean. At the beginning, we need to create project. We need to put projects which are, first of all, scalable, and when we will accelerate the process. And to make those projects, we need people. So that's why in each project, you will see that it's always coming from either a non-profit organization. Coral Reef has been initiated by Monaco, a foundation of Albert II, and Paul Allen Foundation. When you look at the R20 is a foundation which is about the 20 region from Arnold Schwarzenegger. So those people have initiated the product. The second thing after that, you need to bring all the people around, scientists, non-profit, off-takers, because you need business. Business will be the one who will generate the economic. Investors, you will bring also sometimes public money or private money in order to launch, in order to generate the product at the beginning. So what we do have here, we have a collective. So we will create a collective, and after that we will decide based on the collective what we will do. We do realize that in the world, as you mentioned before, 60% of the problems are coming from smallholders or SMEs. So that means we have to address that. And it's a combination of climate issues, it's a combination of biodiversity protection, and also social. Sometimes it's by solving the social part that we will be able to address the biodiversity, which will solve also the climate issues. So the idea is to create structure when we have to make a product which will be impactful. So for that, most of the time, because it's new and you want to attract investors, you need to de-risk. So after scaling, the second part that we need to take action to is the de-risking. And the way to de-risk today is to bring philanthropic money with concessional loans, or is to bring public money. So we have to align different sources of funding: philanthropic, private, and public. Why the private is important? And I take the example of the coral reef. The coral reef is a conservation action first. So we do that for adaptation in order to save the coral reef. So we will start from the conservation issues, put a consortium around it by bringing all the parties. And what is important is that we will bring private business, private investors that will create the resilience, the financial resilience, in addition of the environmental resilience, by creating also social resilience, by creating business that will be able to complete the donation from the public and the philanthropic in order to create the resilient financing and to be able to do the conservation of those coral reef. So we are mixing business and we are bringing private business in order to complete. In the other example, like we have in the SNCF, SNCF is a fund that we created with IUCN, R20, BNP Paribas, Pegasus Capital. So we have different players here, gold standard. And the idea here is to finance middle-sized projects from 5 to 75 million in emerging market. All the projects were either too big for philanthropics or too small for banking. So we are completing that area. And what we will do is that all those projects, which will be about renewable, which will be about waste to energy for cities and for region, will be reviewed by IUCN in making sure that they are integrating all the SDG, and on top of that, taking care of the biodiversity and making sure that there is no negative impact of biodiversity. So here we have another model where we are creating businesses for non-bankable project. By pooling them, we will be able to make them. It will be de-risked by a public money, and at the same time, we will make this fund certified properly by non-profit organization like IUCN on gold standard. And so this is the kind of thing. So the banks used to provide products and services, but what we will have to try to do in order to complete and to be able to finance the transition today is to be able to create products, but also solutions like those one, which will create pilots that we can scale, accelerating some process. I just want to mention that all those structure, the smallest is about 100 million, and the largest one will go up to 5 billion. So we can, with 5 billion, if we manage to complete the financing of it, you can imagine the number of impact that we can realize with that. And financing to make impact, but financing to make return and impact is really what we want to achieve with this type of products.
Fantastic. Thank you, Pierre. We don't have time for a follow-up for you now, but I think we're going to hear a lot more from you later. And actually, I think that provides us with a really nice segue to bring in Nano. Nano, public and private finance, we need to work together. I understand that Anne Green, the fund that you're representing today, was partly came about from Norway and Norway's International Climate Finance Initiative, which has allocated billions to incentivizing the halting of tropical deforestation through results-based payment. I know in the UK, we're very proud of the partnership with Norway and Germany, the GNU partnership, to try and reduce deforestation. Fantastic that the Anne Green Fund is doing what it's doing. But of course, obviously, we also do need the private sector. It's critical if we're going to really push towards sustainable solutions. And Anne Green, I think, provides a really good example of how you could bring those two together and very strong collaboration. Could you talk to us a little bit about how this fund came about, what challenges it is intended to address, and how is it all going?
Thank you, Helen. Yes, of course. Well, it was about 3 years ago that we started to create a fund. That was on initiative of NICFI, as you say, the Norwegians, and IDH, initiative, the Sustainable Trade in the Netherlands, with the idea, what was the experience of the Norwegian government, was that they have been working mainly with the public sector. In reality, they saw that was going very slow. So they wanted to have an initiative that focused on the private sector. So they provided the startup capital for a fund, and for the Anne Green Fund. And the fund, let's say, Anne Green invests in commercial projects in the agriculture production value chains in order to protect and restore tropical forest and peatland. So it is to make, let's say, the main commodities deforestation free. So then we're talking about palm oil, about livestock, about rubber, soy, all those crops that have a huge impact on deforestation. And the fund wants to work at scale, because really to transform markets and show that this can be done and prove that this can be done commercially. So that was the basis of our idea. And then what's also special about the fund is that we work in, let's say we have a landscape approach. So the fund only works in jurisdictions where the local government has a clear plan on how to stop and reduce deforestation and is accountable for it, so that it has set goals and that those goals can be monitored. So that means that the fund operates in an environment where it helps let's say, those landscape protection plans are made with the civil society, the private sector, the public sector. So really, it's a very inclusive approach. I think what speaks for itself is that the fund, the goals of the fund show what we were aiming at. So we are aiming at protecting and preserving 5 million hectares of tropical forest to include 500,000 households that will benefit from the project of the fund. And let's say to de-risk and help private companies to really change their business model. So maybe it's interesting to, so we are operating regionally. We are very active in Brazil, in Indonesia. We are looking at Latin America, apart from Brazil, also in Colombia and Peru, and in Africa. And let me give some of the examples. One of the examples is a project TLFF has been working on, which is ROU, a rubber plantation in Indonesia, which is going to protect 150,000 hectares of tropical forest. And TLFF is let's say, has structured the finance, and FMO and Green has made it possible that this finance comes together with a very long-term 10 to 15 year participation in the financial structure. So this includes, let's say, the conservation of tropical forest and smallholders that in the second phase will be included in the projects. Another example is also in Indonesia, that's palm oil, where we're financing a big palm oil producer who is taking off the palm oil from smallholders, for a big part from smallholders, and they're going to improve the management and stop the deforestation smallholders are doing. So they're providing them with inputs and they're providing them with finance to improve their business systems. So I think it's important to reach out, as the theme also of the panel was, to SMEs through the big aggregators, because for banks or for other financial institutions, it is very difficult and cumbersome to get the information and to get the, let's say, the performance of these smallholders. Well, these companies know, so they can be helped, and they can be the, let's say, the link between the finance and the final end user. Another example is a project in Brazil. That's a livestock project, Roncador, in Mato Grosso. And there we are looking at an integrated livestock management project, which will, let's say, protect 70,000 hectares and will include thousands of smallholders. So I think this is the idea. The idea is to come to a fund. We have now the participation of, apart from NICFI, from Unilever, who has provided capital, JEF, the Global Environmental Fund. We are talking to the DFIs, and we see that also bigger insurance companies are interested in investing in the fund, not so much as a commercial business, but as let's say as a CSR business. But that's important to show that this can be done, because there's no fund similar to and Green in the market at this moment in time. And with the 400 million, we expect that we can mobilize 2 billion of investments in this space. And so it's really about scale, bigger companies that change their business model.
Fantastic. Thank you, Nano. And I think you brought up an issue as well that Toby referenced right at the beginning, this important of patient capital. I think you were talking about, your plantation. It was a 10 to 15 year period that you were looking at. And I think this importance of this patient capital is really coming out, especially around sort of agribusiness and those kinds of investments. It's really interesting to hear you talk about that. Just thinking about, you have extensive experience at FMO as well. And, we're looking after SME investments on that side as well. Are there any lessons or instruments or ways of working more generally across SMEs that you saw in your previous life, as it were, that we could take away and think about for SMEs on the nature side?
Yes, absolutely. So I think the big challenge with SMEs, as I mentioned, is the lack of information for the company or the bank that financed them. So you need an aggregator, and you need players that understand, that have the information about what is a good entrepreneur and what isn't. So gathering the information is very costly, and bringing those groups together so that you can get scale. Those are the two things that are very costly. So you need an aggregator. Such an aggregator can be, in some cases, microfinance, but in general for SMEs, of course, that's too small amounts of finance. So it can be a bank, and it can be companies. So you have to start looking at aggregators, and it can be cooperatives, of course. No, so that is very key. And the big challenge is to keep, let's say, to keep the cost low, and that means that there are two kinds of cost. Of course, the operational cost of providing the credit and getting the money there, and getting the information, as I mentioned, what you need, and the cost of aggregating, organizing the farmers. So those costs you have to keep low. So sometimes you will have to blend the finance, need some technical assistance and money to do that work in order to get to make it possible to access a larger amounts of SMEs. I think that's in general where the big issue in SMEs is. And in nature, let's say, of course, it gets more complicated because the whole environmental and social aspects of land rights, of let's say the whole deforestation, because as I think it was Pierre that mentioned, 60% of deforestation is caused by smallholders. So it is also very, let's say, very complicated to get all those information and to get the control over the supply chain. So our experience is that can be done, and you need very dedicated and very, let's say, committed bigger companies that can make a big difference there.
Fantastic. Thank you, Nano. Yes, I mean, this point about aggregation really is critical. And then also this point just about looking across your whole supply chain and really active engagement and working with the folk on the ground, those smallholders. And, you know, Katrina mentioned something similar early on in her intervention as well. Can definitely see there's some themes coming out. I'm going to turn now to Richenda. So I think when I introduced you, I referenced, or made reference at least, to your fantastic experience scanning from impact investing and international women's micro-entrepreneurship, all the way to improving sustainable energy access in Africa. And now here you are working with the Aspen Network. It'd be great to hear from you, to get your thoughts about what you think the key enabling policies and practices are. What's the role really of governments to support this? We've got some really interesting insights, I think, from Toby about what's happening on the ground, you know, Katrina across the supply chains, both Pierre and Nano about the funds and the role of public and private finance coming together. Could you talk to us a little bit about what do you think the role of governments and those sort of overarching frameworks are?
Yeah, thank you, Helen. It's a pleasure to be with you all this afternoon. Just to kick off and bring some examples that I've really focused on in the renewable energy sector, which 10, 12 years ago, there really was no off-grid renewable energy sector. And we did see that there was a need really for an ecosystem approach to build that sector. And so I would just start off by saying that it actually takes an ecosystem to support ecosystems, which is really of governments, development finance institutions, non-profit organizations, and all pieces of the ecosystem to work productively together alongside strict investment funds and approaches, because companies do need investment, and they also need other types of support well beyond investment. So just to say that investment alone is generally not sufficient to really move markets. From the off-grid energy sector, one of the things that we found was that in building the whole sector, because a lot of the SMEs that we were working with, or SGBs as we call them at the Aspen Network for Development Entrepreneurs, because they're small and growing businesses that are looking for capital, we really saw that actually there was a need for research, there was a need for market development, engagement at the local level, at the national level, as well as globally, that required financial support outside of the businesses because they just could not carry those R&D costs within the businesses. So one really effective approach that was started by the World Bank and the International Finance Corporation was called Lighting Africa, which was really focusing on key markets where we wanted to make a difference and going with a deep dive into the data about what did the market need, what was holding it back, what did the entrepreneurs need. It never provided direct capital support to the entrepreneurs, but it really helped to provide the data that they needed also to grow their own markets and took that burden off their own balance sheet. So that's certainly one area where I'd say that there can be sustained support by governments. And of course, more generally on the enabling policy side in terms of how do you actually look at the overall situation for small and medium-sized enterprises in your own country context. But I also want to say some good news, which is that this week, we just launched our Impact Investing in Latin America Trends Report at Andy, looking at the last 2 years, 2018 to 2019. And what was encouraging is that 70% of investors in that region are already aligning their measurement with the Sustainable Development Goals. So that's definitely some strong progress in terms of investors really being attuned to sustainability outcomes. I would say that the previous remarks about patient capital really resonated with me, and I think this is where a government can come in as well, particularly through the work of development finance institutions. I would say we need patient capital, but we suffer from impatient investors. And again, drawing on the renewable energy experience, particularly in the off-grid small-scale solar sector, we did need a lot of blended finance in order to be able to help those companies to grow and stabilize and really take off in their own particular markets. And if you talk to some of the companies that have been able to very successfully raise commercial capital, that's kind of a little bit the dirty secret that they don't really like to talk about. But there were many of us when I was on the foundation side as well as governments that have been very much there providing concessional financing that can really help pave the way for later commercial capital in some cases. But again, the previous remark about the tenure of the need for patient capital really resonated as well, because we saw that some of these businesses, not like the IT sector where you're sort of 2 years, 3 years and then an IPO, at least that's how it seems in Silicon Valley, but really it needed 7, 8, 9 years of patient capital, as well as right-sizing return expectations. You're not necessarily looking at your 20+% emerging market IRRs across the board. So you really need to look also at the right types of capital. One other thing I want to say, which has been very encouraging, where governments have come in a particular example in several of our Andy members, has been a new platform in the Amazon, which has been more bespoke focus. And I think also having that sort of very targeted focus in a particular area with your fund can be very helpful in terms of being able to then really focus on key issues that are particularly relevant for that sector. And one I just want to mention briefly is called the Partnership Platform for the Amazon, which is a new network, private sector-led collective action platform with 40 members ranging from small to medium and large companies that was set up by USAID, Fundo Valley, and supported by Sitawi. All three of them are members of Andy, which has really been focusing on the 25 million people living in the Amazonian region and helping to support entrepreneurs within that region, and really looking at how they can come together, provide not only the access to capital, but also the other supports in terms of mentoring, in terms of skills building that are required, because as I said, it takes an ecosystem to support ecosystems.
I love that phrase, ecosystems to support ecosystems. It's definitely one of my takeaways. And And I think also, I think it was Pierre that mentioned before, finance ultimately is a means to an end. It's not an end in and of itself. And, supporting these businesses needs all sorts of different kinds of support, technical assistance, blended finance, and I sort of really taking away this point around focusing in on a sector and trying to tackle the challenges within those sectors. Rajendra, in a conversation that you and I had, not actually at this panel, we touched a little bit about the international SMEs and local SMEs and their ability to access capital. What do you think we can be doing with local financial institutions to help them get a bit more comfortable with investing in local businesses, or indeed DFIs and international investors getting more comfortable with domestic homegrown SMEs?
Oh, that's a great question, Helen, and I'm really pleased that you asked that, because we have seen a lot of companies struggle when they've been accessing capital internationally, but really they need access to local capital because of things like currency fluctuations that can really really hurt the businesses. So there's some good examples that are coming up now of great cooperation, again, between international and local partners to drive more capital into local green businesses. And one example I want to provide comes from one of our members operating in South Africa, which is called the Green Outcomes Fund, which is a newer fund there in South Africa, a partnership between the World Bank, the World Wildlife Fund, and Green Cape, which was launched earlier this year, really to look at overcoming challenges of low local investor interest, lack of BDS support, business development support, limited access to the market, and also sometimes limited technical understanding of climate, water, waste, and other green job generating enterprises. And what they've done is come together within a sort of collective platform again, using both a combination of concessional financing, about 90 million rand, to then catalyze an extra 390 million rand in private capital to come in. And part of what it does is it's not about circumventing local investors. It's really about helping to stimulate that local investor support by subsidizing the green small business investment, and that in a way sort of providing those incentives to help overcome some of the perceptual or real challenges that local investors have had in the past. So that's another good example of how you can bring in a combination of capital to address some of the other challenges like high startup costs as well as high transaction costs, where in fact, particularly when you're looking at a smaller ticket size, it may just not be that interesting to a local, fully commercial capital provider. So it can help to sweeten the deal for them.
Yeah, the more that we, I don't think I'm on. Oh, there we go. Yes, that's fantastic. I think the more support that we can get to these sectors on the ground and getting that rich diversity experience, so we can really get this sector moving, the better. Rajendra, thank you so much. I think that sort of brings us to a conclusion for the first part of this panel, and we're going to move now into Q&A. There's been a number of themes that you have all brought out in this first half, which I'm hoping now that we can pick up in a Q&A session. To begin with, though, I mean, obviously, COVID has changed a lot, and arguably, you could say that this has increased the need and the attention to want to invest and protect and restore our natural environment. And Rajendra, actually, just the point that you were raising around 70% are aligning with the SDGs in Latin America is really encouraging. That being said, COVID has changed things. I know in the UK, we're sort of thinking, could the impacts of COVID really threaten the environmental sector, disrupting, existing project pipelines, fundraising, which could ultimately result in loss of jobs and capacity and expertise from the sector. We've acted quickly to try and safeguard this expertise in the UK. We've launched a Green Recovery Challenge Fund to really support that pipeline and that capacity. But interested to get your thoughts about how COVID is impacting interest, both on the ground from companies, but also investors to really want to go big in the sector. Has it changed anything? Is it actually going in the right or the wrong direction? Toby, maybe you could kick us off on this one.
I'd be happy to. COVID's had a significant impact on our operations for several reasons. One, in Colombia itself, which at the beginning of sort of the COVID pandemic, Colombia was one of the better performing countries around the world if you looked at the per capita data, but has since become one of the worst. In order for us to protect our operations on the ground in a very remote area of Vichada, Colombia, we've had to put very stringent protocols in place that really restrict the movement of people, because there aren't the medical facilities in that part of the world to deal effectively with this kind of pandemic. That obviously curtails our operations, and in curtailing our operations, it has put the pause button on our ability to raise additional funding. And this is one of the real challenges of an operating company such as ourselves. You know, you've got cash requirements in order to just keep the business and protect the assets moving forward. But investors, when they come across an issue such as this, put the pause button on, and we've gone from a closing date on our next round of capital from April, the intended date, to October, and now October's moved to February. That puts an enormous strain on a company such as ours, and there's still no guarantees that we'll close in February of next year. And so in order to conserve cash, we basically have stopped all of our planting and land acquisition activities, which only further delays our ability to achieve the scalability we talked about earlier and achieve our overall objectives and have the impact that we intend to have. And so it has had a very material impact on us. And we're still not sure we see the light at the end of the tunnel.
Yeah, it really has sapped demand for quite a lot of products, hasn't it? Katrina, I don't know from your perspective in Karen, are you sort of seen something similar? Oh, I think you might be on mute.
Okay, can you hear me?
Perfect.
Okay, great. So yeah, I'll pick up where Toby left off and talk about on the other side of the tunnel. And I think on a positive note, actually, I would say that before COVID hit, when we look out into to our peers who are in food production and in fashion and so on, many of them had funds in the works before COVID. And as we did the legwork to launch our own fund, of course, we looked out to see who was doing what and had many conversations. And I mean, I think I've been actually quite heartened by the number of funds that have launched in 2020 that are specifically focused on climate and on biodiversity. I think many of them are actually profiled this week and over next week as well. And so Danone, Unilever, L'Oreal, Microsoft, Amazon. So I think that I definitely have empathy that this is a frustrating period and there's limited bandwidth to apply for funds. I would say that on the flip side, there is money that is out there for SMEs that are working at the forefront of food and fiber production specifically. It's a matter of connecting.
Maybe I can say a few things about COVID. First of all, COVID has demonstrated several things in finance. The ability to mobilize a lot of money when we are under stress. We talk about blended finance and how difficult it was sometimes to set up projects and to put all this together and how long it takes. I just want to mention that we did blended finance without knowing it during COVID, when we see all government raising public money in order to guarantee private business. The good example is in France, for instance, when BPI, which is a public bank, guarantee most of the private loans through banks, and it took 3 days to put this in place, and they made 10 billion in a few minutes. So we can demonstrate also when we will be more and more under pressure, that probably we will have more reaction that normally we take so long to put in place. When we see how terrible is it to put a blended finance a transaction, and Richard that told us a few minutes ago that it's very important to put that, and this is the future, but it takes so long to be put in place. where suddenly COVID have arrived. We mobilize more or less most in the world the equivalent money that normally we need for COP21, so which has been designed for that. The second things that we have seen in COVID, which for me is very important, is that it exacerbates the inequities. So we can see this is the middle people and the poor people and the small order people who are suffering the most. So this is why we need to accelerate, invest faster, all those projects about small orders, farmers, fishermen, because they are the one who keep the nature. They are the one who will protect the nature for us. And if they are in a more difficult situation, what will happen? They will continue to destroy the forest. They will continue because they need to eat. They need money. They need to feed their family. So we don't have to forget, for me, all those mid-sized small orders, fishermen, because they are the one who need probably more than ever all the support that we need to do. So I hope that COVID has been a waking call for quite a lot of people in order to accelerate what we are struggling to do in the past few years.
Thanks, Pierre. I mean, it's action needed across all parties, isn't it? Public, private. I mean, also the international financial institutions. I know, for example, the World Bank is doing a lot of their development policy operations at the moment, their DPOs, immediate budget support to help countries. You know, at a sovereign level, this lack of demand is also impacting on them as well. Richendra, I don't know if you have any thoughts specifically about what you think the MDBs could be doing more of to support us through this period.
Well, I'd rather focus on something about the blended finance. I agree with Pierre that in fact it doesn't always take a long time to get those funds out. And one of our newest members, or almost members of Andy Connects Us, has actually really been focusing in Brazil on the needs of community-based enterprises. And one thing I'd like to say is it's not only about new enterprises, it's also about how we can support existing enterprises. And they mapped 402 community enterprises in the Brazilian biome and found about 90 of them that all lacked sufficient revenues. They were all operating in sort of subpar status in terms of about 140,000 in revenues. And they have come in, and since 2016, they have done 22 deals with 60 community enterprises, really to focus on providing blended finance for forest dwellers and cooperatives in that area. And also they have come in since COVID and put together a $2 million new line of credit for those enterprises, exactly to help those rural communities not only survive COVID, but also to thrive. One other point I do want to make, though, where there's a differential impact is just more generally, I think we all need to keep a really careful eye out on the women-led businesses and the women-led enterprises. An unusual finding, perhaps, from Andy recently was that actually accelerator programs tended to exacerbate the divide between women-led and men-led businesses rather than overcome it. So I think given COVID, in parts of the world, women entrepreneurs have had particular pressure on their businesses. We really also need to look at the gender side as well and make sure that whatever we are doing financially is also providing needed support to help women-led businesses survive in this area as well.
Thank you, Richendra, and a fantastic reminder on the the inequality issue around male and female investing. I think that's a really pertinent point. I'm just thinking, would it be useful? We've talked a lot about blended finance and the role of that to really get these businesses to scale. I'd like to talk maybe a little bit about what kinds of instruments these small companies need. Is it equity? Is it debt? Is it actually a combination of those? And that's what's difficult, because financial institutions or funds just want to offer one instrument, and actually what you need is a whole package of different kinds of support, technical assistance, guarantees. I wonder if somebody could share some thoughts on that. Nano, maybe we could go to you, hear from you both on what Anne Green is doing, but also from some of the wider stuff you have seen.
Yes, thanks for that question. let's say equity for small businesses is quite complicated. That's in general the case, because it needs to be quite a formal company. You need a governance. So it is the follow-up. It's very intensive. So equity is a complicated, as I've seen it, product. You see a lot of private equity funds all over the world in emerging markets focusing on SMEs. And the issue there is that it is difficult to make those successful and to attract commercial money, so you really get it at scale. So where I've seen in my experience within FMO and the DFI, more success is in a kind of subordinated debt and debt. It's easier to provide. It's more a standard product. So there are more possibilities, and then combine it with what I mentioned earlier, with let's say companies and SME companies related to nature, to forest. Then it is in a lot of cases it complicates more. Let's say it's more complicated to finance an SME in the Amazonian area because of all the let's say it's a complicated environment. What I mentioned in land rights, in indigenous people, what you need is to combine what is said. No, money is not the only solution. Money is needed, but you need a combination of government, of NGOs, of private sector that work together to create an environment where you can finance large numbers of SMEs. And then I would say that it's easier to build up those programs and get them at scale if you look at debt and subordinated debt, more standardized product combined with support services for those SMEs to be able to pay back the debt. I think that is it. And then, as I mentioned, in the case of Ant Green, we are very much looking through the supply chain, not directly working with SMEs, because that's not the outfit. It is we have too much of a distance. You need to work with parties that are very close to the SMEs.
Thanks, Nano. I'm going to go to Toby now, actually. It'd be really interesting to get your thoughts on this question on instruments. When did you want to get equity? When did you want to get the subordinated debt? Tell us a little bit about your thoughts on these issues.
Yeah, no, happy to. I especially taking off on Nano's comments, there's an enormous bias out there, especially amongst the development banks, the World Bank, the IFC, and other institutional investors to start with debt. From my perspective, that is all wrong. The development banks in particular need to completely rethink their approach to sustainable forestry. Debt is absolutely the wrong way to go. You need to go with equity, and you need to stay with equity for a very long period of time. Equity is the only way in order to finance a long-term investment like sustainable forestry. And because of that bias for debt, there's a bias to get into a project only after it's producing cash, because that's the time in which you can actually repay the principal and debt. We've tried to structure debt in this company on several occasions, but the deferral of principal and interest is so long that it's very difficult for anybody but the most creative financial institution to get their head around it. And so as a result, even though we spent years and years and years speaking to the development banks, we have yet to do a deal, a debt deal with a development bank, even though if you read everything they stand for, a project like this personifies exactly what they say they want to do, but they rule themselves out because they can't be in the equity side of your balance sheet. So you end up getting very creative as a result, and you look towards high net worth, you look towards family offices, you look towards the oil companies, as I said, in our case with Shell, to sell carbon credits forward in a preferred equity structure. You have to get enormously creative in order to fund a company like this, because the big institutional buyers have such a heavy emphasis on debt. So I'm a very strong proponent for equity. I'm seeing some small movements in that direction. In other words, I'm seeing the senior management of many of these firms say they want to do more equity, but they really, really struggle. The other thing that I would say is that on the fund side, there are many funds, and Green, I'll pick on you, you're as one of them, they have a very specific focus, like in reducing deforestation, for example, or advancing a cause in this area or that area. And as a result, if you're a sustainable forestry company such as our own, it makes it extremely difficult to bring multiple organizations together at the same time to provide funding, because you have all these competing influences that you're trying to satisfy along the way. And you end up in a situation where not only does it take not just months, but years to come to grips with those competing influences, but the due diligence process oftentimes goes on for many, many months and years, to the point of analysis paralysis, which again, as a startup company, you cannot afford that kind of time lag. Even though you may have the willingness, you can't stretch that kind of funding discussion out for 18 to 24 months. And so I think these institutions that want to be engaged and really want to do the right thing have to rethink their entire approach to getting involved in this sector.
Toby, this is, this is fascinating. It resonates actually a lot on work that I was doing when I was in now FCDO, it was then DFID. We actually had an investment company called Financial Sector Deepening Africa, and they did a combination of debt and equity and very, very early stage businesses. And their steer to us was people need equity. They sort of need to get the cash flow sorted, and as you said, that due diligence process can take an awfully long time. Now, this is obviously risky, but we had a whole ecosystem of well, back to Rashendra's point, you need an ecosystem to help an ecosystem. Yeah. A whole ecosystem of support around that. Pierre, it'd be good to come to you just on this point on debt and equity.
Yeah.
What's the ratio? Tell us more.
I think is a very interesting point, and I tend to agree with Toby. And that equity is the one that we need to push. And when we are moving on the SNCF fund that I described, it's a private equity fund. So we want equity to be there, because equity is the way that we can also create a value and move the value up, and create this movement of creating value, because nature-based solution is about creating value. And at the end, if we want the value to be reflected in the business, the equity is the best instrument. After that, we can play with instrument as we move, and creating a blended finance tools with equity. This is what we try to push, because at the beginning, you may help big investor to come in, but at the end, we can move. And convertible is also an instrument I quite like, because some people feel uncomfortable at the beginning. Maybe they like this mix between debt and equity, but at the end, they're quite happy to convert it in equity. And I do believe that we have to push for equity, because at the end is about valuing the forest. And this is also the language we need to use. And I give you an example. If you say that, we will save the forest, or if you say, a forest, an hectare of forest is $10,000 and you can make a return on it, which is about 30 or 35%, then you have a different language about bringing the finance into the valuation of what represents the nature. And I do believe that we do not put enough valuation at what nature is. Nature has a huge value. We demonstrate that. And if we can transform this by putting the figures and the business model around it, and equity is the most appropriate for it, I think we will interest much more investor. And I will tell you one thing. Today, what we do see a lot of sovereign funds which are starting to get in equity business. Of course, they need several mechanisms to get that through different funds or through different asset management structure. And what is interesting also, we are thinking at BNP Paribas to create fund of private equity related to sustainability, because that will bring the investor to the retail investor, because if we put some protection, and then you can extend the knowledge about what we do, not only to institutional investors, but also to high net worth individual, and going more and more to each investor. So I think it's very important that we do keep all those kind of instruments, depending what kind of investor we would like to reach to.
Yeah, I think that fund-of-fund model sounds really interesting, and especially this idea that you are developing a sort of a wider network of investors that are understanding this landscape. I'd love to pick up with you after this panel and find out some more. We've talked a bit, you just talked a bit about value, and Katrina, I'm just reflecting on where you were, when you first started talking about your sort of natural capital and natural capital accounting. I know in some of the conversations I have, sometimes people say the data is not good enough, or we don't have it there. You know, you can go down a rabbit hole of accounting, but it sounds like you guys have found the perfect solution. You've got the balance just right. What are your thoughts about data, and how can we use it to really support these kinds of investments and transparency around them?
Yeah, just to echo what Pierre was just saying, I think that when you can start to move towards natural capital accounting, it just provides a really powerful tool to understand how to prioritize investments, how to prioritize programmatic decisions, and so on. Because what you're doing is in our case, we're looking at 6 different environmental parameters. So emissions, land use change, and many others. 4 others to be precise. And then using LCAs, we're able to quantify impacts depending on the country and the material, and then convert that into a dollar value, which lets us compare apples to apples. And so that can be very powerful. You used the term perfect, Helen, and I would say it's not perfect. I think that the method is very strong, and what we need to make it even better are more LCAs. And so sometimes, we'll have a particular LCA for a particular, for organic cotton in India, say, and we need additional LCAs across the full supply chain. And of course, that doesn't apply only to our industry, it applies to everyone who's involved with raw material production.
There is, Hélène, something very important for moving on the natural-based solution and accounting the nature is data. We need information and we need data, and we need information which is also, I will say, clear, public, and that we can share across everybody. Because today everybody builds his own world of data, and the problem is that we are counting pears and apples, and it's very difficult to compare to each other. And this is what we missed today: is a central custodian of data that can be used for measuring impact and also starting to measure and account for nature. And at least we surprisingly, nobody is jumping on that. And there is a lot of people working on collecting data, like the big GAFA, the NASA, as mentioned before by Katrina, etc. A lot of people do that, but there is no consolidation, and there is no people conserving, maintaining, and making sure that we can use the data. The data is much more important than the methodology. Methodology can evolve as the world evolves, but the fact that we can use the same data in order to measure nature and to measure impact that we need to measure in the future, because even in a financial decision, we will have to use impact as a decision process. We have the risk return, but also the impact will become more and more one of the decision process for any investors. So if we don't have a proper system to decide what, like we did for risk return and financial risk return, and defining counterpart risk, etc., it will be very difficult to move forward and to have a common system in order to bring the investor in that direction.
Yeah, just to pick up on that, I agree with that very much, and that's an area where Andy focuses on very much, is looking at the research and the data. But I want to emphasize a former point, which is making sure that we're not burdening the entrepreneurs like Toby to have to be collecting the data on their own balance sheet unless they're adequately invested. They've got the financing that really supports them to do that. I think one of the interesting trends that we're seeing in the sector is the increased digitization of a lot of areas relevant to different types of SME, and that's an area where perhaps it may make data collection more easier in the future. Plus, we're also seeing at least drawing from the renewable energy sector again, some of the satellite imagery that's able to look at certain types of data, again, off the balance sheet of the entrepreneur. I really want to emphasize, I completely agree with Toby's plea for equity. I mean, I think that's been a perennial challenge for SMEs in the 20 years that I've been in what I would call not the missing middle, but the marvelous middle. So I do encourage investors to come in. If you're here, if you're listening to us, please bring equity.
I love it, a marvelous middle. Toby, do you want to come in on this? And then Nano, it's going to go over to you before we'll have to close. Toby.
Yeah, I would just say that I appreciate everybody's comments, especially those regarding equity. And the data comment is quite an interesting one, and I'll raise another challenge that we face in the field. You often get questions on the due diligence process about the true impacts that you're having in the field. And while sort of anecdotally, and it just makes good common sense that you might be having a specific improvement, say on soil quality, for example, and reduced erosion by having trees there versus burned grassland every year. But there's often the demand for proving that, where we have to actually produce the data. And that often takes years actually to produce. So it's not only a resource issue, it's another timing issue. And you get yourself into this chicken and egg situation on a wide range of those data-like questions, because there's this very sort of dogmatic approach that, I've got to have this data in order for me to make that investment. And we just ask people to sort of take a good hard look and take a bit of a leap of faith and work with us as partners to prove that point, but over time. Because if we have to do it up front, oftentimes you're just never going to get there. And so that equity and that partnership through institutions who have the wherewithal to act in that way are the ones that we're looking for. And in our case, persistence pays off, because the more persistent and creative we become, the more successful we become. And I think we will win this war because people are moving in our direction. I'd just like them to move a little bit quicker.
Wouldn't we all, Toby? No, final word from you.
Yes, well, maybe surprisingly, but I agree completely with the equity that it should be there. The question is then what institutions are best suited for it. So I think what Pierre was saying, what Toby was saying, the high net worth individuals. So it has to be institutions that are very flexible. And if you see the way governments provide money, it's one that Toby says it's focused on something that's politically important at that moment in time. So it's always specific. They don't say, here's the money, save nature. No, so that's and you do what's best. That's one. So and there's a very high problem of risk averseness in governments. So what you see if you're going, especially if you go to nature, if you go to tropical forest, they are willing to finance. But if there's any problem with land tenure, is there any problem with indigenous people? If there's any problem, they don't want to have that, because then there's a political problem. So I think what we need to look at is much more private sector, much more at maybe the what's said high net worth individuals, people who can do this without having the complete political scrutiny, because what I've seen over years, that is really a problem. And also to set up private equity funds. I've been involved in it for 30 years to make money on SMEs. It sounds very nice, and for sure Toby's right, and I suppose, and in his situation, what he needs is equity. That's very clear. But to create a fund which invests in equity and is successful that the money comes back and you make a return, that's what I've been working in for the last 30 years. And I can tell you that's not easy, and it's more complicated when you do it with government money, because then there's a lot of scrutiny, which is the scrutiny as such, and transparency is right, but there's a huge risk averseness in that everything has to go right, and when there is a mistake or something goes wrong, which in reality is the case, then it's a showstopper, instead of we have to learn from it and we go on. So I think that there are huge dilemmas there in how you finance it and how to get the right structures. But I agree completely that equity is key, but it is easier to say than to make it work.
Yes. I hear there's a sort of a maybe 1 out of 10 SMEs ends up being successful. I've heard that ratio before. It's not easy, but the ones that do make a huge difference. Everybody, we're slightly over time, so it's really just left for me now to say thank you to all of you. It's been a fantastic discussion. We've touched on all of the challenges that SMEs, especially in the nature sector, are facing, be that data, be that information, be this need but lack of patient capital and equity in particular. But I hope there has been a bit of inspiration. There are a lot of funds coming up. I was really inspired by Richenda talking about 70% of firms aligning with SDGs in Latin America and the Green Outcomes Fund. I think there's a lot of opportunity out there. I think it's left for us to grasp it and to really create those innovations in private finance so we can fund the missing middle or marvelous middle. I think we should start calling it marvelous middle, the marvelous middle of nature. So thank you very much. This is part of the global series of nature, and it's going to continue in January 2021. So thank you. Partnerships for people, prosperity and planet. Thank you.
A huge thank you to all who joined us for the day 2 of the Nature for Life Hub. While we take the weekend to reflect on these conversations, we also urge you to think on how you can be part of the solution. Join us next week, starting Monday, September 28th, as we resume the conversation around increasing ambition and taking bolder actions for nature. Watch this space, and please, again, let us know what you think with the hashtag Nature for Life. Have a great weekend. Ciao.